Look at this man. He wrote one of the best books for systematic trading. He isn't just an author, he's a former rocket scientist. He designed systems used on Apollo missions. He's a former head of trading systems, and he was also an advisor to hedge funds and also security houses. Here are 7 lessons from him you need to hear. I'm Manir, also known as Ghostwalk Trades on Twitter, and I also run Unbiased Trading, an agency where we can backtest and automate your trading systems. Now, the first lesson is based on the loose pants concept that he mentions in his books.
A very important concept. It really means that it's an argument against overfitting. Loose pants means you have as few rules as possible, and you need to accept the risk and the variation that goes along with that, because it will account for situations that you haven't seen before. When you overfit something, or when you try to fit something carefully and you specify a particular profit-taking level or stop, you find that in the future, those numbers don't mean anything, that the market doesn't repeat the way it had in the past. And the only way you can succeed is to generalize the rules. And you can do it by testing a profit level across a lot of different markets. And you make the profit level based on volatility, so it self-adjusts. And I find that in general, for example, a profit level of 3.5 ATRs for intraday trading works, or for short-term trading in general, works very well across most markets. You could try to make that bigger or smaller for specific markets, but I think you'll find you'll be disappointed in the long run that it really doesn't improve anything, that you're hoping that the market in the future will be exactly the same as the market in the past.
So primarily this concept is all about trying to not overfit. So what he's saying here is have fewer parameters, and those parameter values should be more generalized, meaning that they shouldn't be specialized over that historical backtest that you've run at 10 times optimizations to find the best EMA length, for example. It really should be overall to be more generalized so that it can work on new out of sample data like live market data, for example. Now, this is a pretty well-known concept to most systematic traders. The biggest obstacle in systematic trading is overfitting for the most part, and that is really just done by over-optimization and having too many parameters often because you're fitting too much to the historical data. So this concept is definitely very true. I try and follow this concept a lot, where I'm trying to follow the least amount of parameter count I can, and then also trying to not run as many optimizations to make sure that those parameters overall are, as he says, more loose pants kind of method. Another great way of doing this is just doing walk forward optimizations. Obviously, you can test then on in-sample data, then it will test those parameter values on out-of-sample data, and you can get a good idea of how it could potentially work on out-of-sample / how it could potentially work on live markets. Now, 2 is don't expect the best performance historically when live. Try and target the average.
So what I do is I really want the average result of all those tests. And that's my target. And I think that's the most realistic goal for traders, is to look at all the results you've tested, get the average of that, and that's what you'll probably get. You won't get the best, you won't get the worst, you'll get the average. Now, to try to get the average in real trading, you need to pick a few of those parameters. And I always suggested, say, 30, 60, 120 for a moving average, or 40, 80, 120. Spread those numbers out. Be careful that you don't pick 2 that are very long, because the percentage difference between a 30 and a 40-day moving average is much bigger than the difference between a 100 and a 110-day moving average. So, if you're picking longer term, you have to make the distance between those 2 choices much bigger in order to get diversification.
Now, this is actually a really common problem with newer systematic traders, I've noticed. A lot of times people will call me, or I'll have a chat with them, and they'll say that their backtest, for example, isn't matching the live performance that they're seeing now. They're expecting that the backtest is going to be, the full truth when running it live, meaning that if it has let's say it did 4%, 5% a month, let's say, on a smaller account, and when live it's only maybe doing 2% or 1%, they will often see that as that, it's not performing as well as it did on the backtest historically. However, most of the time, depending on how well you backtest, you're realistically not going to see the same sort of results as you will when live. Like Cliff Afness, I believe, has a very famous sort of quote around that. They normally look at half of the out of sample performance as what they'll be normally targeting or achieving. And this is pretty much what Perry J. Kaufman is saying as well, is that when you run this system live, you're normally going to be seeing the average performance and you're not going to be seeing the best performance you've seen historically. And this is just something to always keep in mind. Now, number 3 is seek out as much data as possible.
But my philosophy is you need to seek out as much data as possible to get as many different patterns as you can, because markets change. Just as an example, what if you had included in 2019, when the market had been going straight up from 2011, you had 8 years of incredibly consistent bull markets. What if you said, okay, I'll only test those 8 years because that's the market we're in? And then all of a sudden in 2020 and 2021, everything changed. And your system was still tuned to a market that was trending up only. I think your system no longer reflects the ability to deal with different situations. And the unfortunate thing is when you include longer amounts of data, the performance doesn't look as good. It has bigger drawdowns. Maybe it doesn't have the returns that a shorter period would have, but that's reality.
Now, this is completely right. He's primarily focusing on, in this clip, around market regimes. If you have too little historical data, you're going to be mainly focused on maybe 1 or maybe 2 market regimes at best. So you want as much data as possible. A really classic example of this is you normally want data before 2020 as well now, because let's say 2020 and 2021, as we can mostly all agree, were outlier years. Now we are having a bit more of a bull run now, I guess in crypto at least, and as I guess especially with SPY as well. So those markets you can definitely look sort of one-to-one, not perfectly, I would say, in my opinion, but at least that's a similar regime. But you'd want to go back even further to see how other regimes have performed with your particular strategy. Now that doesn't mean your strategy needs to perform amazingly in every regime. It would be unfounded for a trend following system to do amazing in a choppy market period. But what you want to see is that it doesn't draw down 100%, for example, and you blow up the whole account. You want to be able to see that it can maintain that sort of level of drawdown, whether that be at 10%, 20%, depending on whatever kind of a risk personality you have personally, and how much risk you're willing to deploy. And also, it's heavily dependent on market volatility. If you're deploying this on crypto, getting 5% drawdown is going to be pretty difficult compared to maybe putting on equities where you could maybe get about a max drawdown of 5 to 10%, give or take. But then also the second reason for seeking out as much data as possible is mainly sample size. Now, one of the most important laws in trading is the law of large numbers. And we want to have as many samples as possible to get to that expected kind of value of the performance of that particular strategy. So if you only have, let's say, a year of data and maybe it's done 100 trades over that year, that's not that much data in reality to have a high confidence on those performance metrics from that backtest. You'd want 10 years, 20 years, depending on obviously the market and then what sort of strategy you're running. But ideally, in a general principle, the more data, the better. Now, it does become a bit more difficult if you're going back to maybe like the 1990s or something like that, or really early 2000s sort of data, as it can be often very different volatility. So you maybe need to modify your strategy or have some sort of walk forward optimization throughout that time. But that is a whole nother conversation for another time. Now, if you need a developer who can backtest and automate your strategies with as much data as possible, visit the link below in the description, and you can set up a call with me and my team, and we can discuss how we could automate or backtest your particular strategy. Now, 4, drawdowns will often mean bigger than you expect.
Anyway, the drawdowns are much bigger than you would expect, even if they don't come too often. If you're in this for the long term, you need to expect to experience these drawdowns and stay with them.
This is a simple line, but it's also a line that holds a lot of weight, because most traders, at least from my experience, normally don't backtest the strategies that thoroughly. So maybe they'll do a single backtest over a single amount of time, for example, or something like that. And they won't do any Monte Carlo simulation or walk forward, etc., or parameter sensitivity. So they don't really have a good expectation, I would say, on how large these drawdowns can be. A really easy way is if you can run a Monte Carlo simulation, whether it be reshuffling, resampling, it'll give you a bit of a better idea of what the maximum or potential maximum drawdown could be. And that gives you a bit of a better idea when you're deploying the strategy live of like, oh, it could actually, in the worst case scenario, it could go down 30%, 40%. And it's a bit better to get those sort of expectations. But I think Perry J. Kaufman is completely right here, is that everyone looks at their historical backtests and think, oh, okay, cool, I'm only going to have a 5% drawdown. Most of the time you'll have some event that comes up in the future which kind of sort of exceeds that, and also it's a lot harder to actually go through those drawdowns compared to seeing it historically. Seeing it historically and seeing, oh, the average drawdown length was 20 days. That sounds pretty easy, doesn't sound that long, but when you're actually in a drawdown for 20 days or 20 days or even longer, that's a whole different conversation of, do you break the strategy, do you change the parameters, do you stop running it, all those sort of things that can come into it. Now, number 5 is, as a beginner, start with the key types such as trend following.
Well, I think that the two biggest um, points of advice I could give is start with trend following, long-term trend following with markets that trend. All right, it is the easiest strategy to understand and the one in which you will get an idea of what kind of profits and what kind of risks you'll experience. But to do that without causing undue anxiety, start as small as possible. You don't want to be trading a position so that if it goes the wrong way, you can't sleep at night. As a beginner, you will see the same patterns if you trade small.
These are two amazing tips to any beginner trader. I would say, I would give number one is start as small as possible. I've heard too many horror stories of people with a decent amount of capital, whether they've sold a business or they've been really profitable in a business or career or whatever, and they start trading with 100K, maybe even more, and they lose a majority of it. I think it's almost a rite of passage. The first year or first 2 years of trading, there's just so many unknowns that you've never experienced, and it's very likely you could lose a big chunk of that capital, or maybe even all of it. So I'd say start as small as possible and build off the key things. You don't need to find the most original edge and the most amazing edge right at the beginning. You could take some time, build up a portfolio of strategies, and as he's saying, you could just start with a simple trend following strategy, see how that goes live, whether it be manual execution or algorithmic execution, and then you can build on it from there, whether it be adding newer version, newer markets, etc. Now, number 6 is different markets are good for different systems.
Different markets are good for different systems. Not all markets work for different systems, and not all systems work on every market. And whether you're a beginning trader or an advanced trader, it's very important to trade the markets that work best on your system. Now, if you're a long-term trend follower, which is one of the most popular strategies and one I use also, then you want mostly interest rates. Interest rates are wonderful for trending.
This is a really good lesson because I don't think the myth is around as much nowadays, but at least when I was starting, a lot of gurus or whoever on Twitter and online would say that you want a strategy that works on all markets. Or I guess the classic is people advertise, hey, I'm selling the strategy that works across all markets. That is really, really uncommon. Some basic principal strategies definitely can maybe work across all markets, but you're not going to see any crazy sort of returns. And they're definitely not going to be well, I guess, optimized. Obviously, you don't want to be overfitted, but for the most part, I would say different markets definitely do trade differently. Especially when I'm trying to do my own futures algorithmic trading, if I try and deploy a strategy I built for NQ on YM or ZB or something like that, it's often not going to work just because volatility is different. It's a different sort of market. It trades differently, and different systems work better for those sort of markets. So you really do want to focus on the markets that help capitalize on that particular strategy you're running even more. So if you're doing trend following, I would say if you're doing trend following, you really should be in crypto markets, at least as one part. You can also then be in obviously equities and indexes. They trend very well, of course. So you could do a portfolio of those, or you could rebalance between those. You could also do single stock strategies of a trend following along those if you want to be maybe, I guess, more advanced. This message is just completely true, and I agree with pretty much everything Perry J. Kaufman says. Now, number 7 is understanding your trading personality.
But some people don't look at the market. They put their money in it and they just stay, and they're convinced that it will return in the long term. Anyway, so you need to sit down with yourself, look yourself in the mirror, and decide what kind of system you can live with, and understand the risks. If you're a short-term trader, you're active in the market all the time, so that's difficult. If you're a long-term trader, you suffer risks, but you're not as active. Somewhere you have to make that decision before you even start.
This is an underrated lesson, in my opinion. I do think there's a side of systematic or algorithmic traders that believe, as long as you can do algorithmic execution, you could run any strategy. It doesn't really matter too much about your personality as long as there's an edge there. Now, I would say that is the top optimum. meaning that, in an ideal case, I think that is technically true. If there's an edge there and you can do algorithmic execution, you should be taking advantage of it. However, in reality, that's not always the case. Most people have different personalities on risk. Most people have different personalities on, how much volatility they can handle and things like that. While I wouldn't say it should be something that should deter you away from an edge. If you find a really amazing edge, maybe you should just go with lower size, for example, if you can't handle too much volatility. But a really easy example is I know another algorithmic trader of mine, and he can handle a lot more risk than me. He puts on bigger size than me. He has way deeper drawdowns, all those sort of things, but he also has way higher returns than me. I personally couldn't handle something like that. And maybe over time, I can develop and improve my sort of personality in that sense where I can handle more of that risk. And I do intend to. But at least at the current time, if I tried to deploy that strategy, I probably would mess it up. I probably would turn it off too quickly. I would probably change it because I'm getting worried that it's not working because I'm in a 40% drawdown or something. Things like that. And those can really mess with any strategy. It doesn't matter if the strategy is profitable. If you turn it off midway because you're in drawdown, it doesn't matter. You need to be able to stomach those drawdowns and stomach the volatility of that particular strategy if you're actually going to run it live. So understanding your personality here and how much you can tolerate is pretty important. Now, obviously, that changes with time. You can, become better at being taking more risk, etc. And I think that happens over the years of being a trader. But this is definitely a key lesson. Now, if you want to learn even more from Perry J. Kaufman, here is one of his most popular books, Trading Systems and Methods. This is the 6th edition. It's a really great book for anyone getting into systematic or algorithmic trading. He goes through some common examples and things like that. And it's not too big of a read. So, if you have a decent amount of time on you and you want to get into it, I'd say this book is a great kind of like a great introduction to it. If you find this type of content valuable and want more every single week, feel free to follow me at Trades on Twitter, or you can subscribe below, and I'm normally posting a video about once per week.